How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to discuss with you pension plans versus 401k plans for dummies, and really go through a comparison. Which one would somebody prefer over the next, and essentially where is the risk involved, and how to really outline the pros and cons of each, and then see which would correlate best to your specific situation. Now, if we're talking about pension plans first, the essentially what a pension plan is it's a type of retirement income. It's known as a defined benefit plan versus a 401k, which would be known as defined contribution plan. Okay, what the heck does that mean? Well, when something's a defined benefit plan, we understand that if you're working for a company or a specific entity, and the example I always refer to is my grandfather. My grandfather worked for the city of New York as an elevator mechanic. So when he was in his 30s, he started working for the city, and he was told when he first started working, saying, "Hey, listen, if you give us X amount of years of service, in this case it was about 25 years of service, we're going to provide you a set retirement income right after you've sufficed a certain amount of years." So sometimes you have pension plans that are designated when you hit, age 60, or it might be when you hit 20 years of service, 30 years of service, 35 years of service, etc. In his case, he understood as long as he went every single day to work, he would be able to collect his salary every single week, every single month, year by year by year as he was working, and the entity, the city, would essentially be placing dollars aside to provide him a lifetime income stream during his retirement. So with pension plans, we understand it's a set income. They're defining exactly what his benefit is going to be after he hit 25 years worth of service. So he started when he was 30 years old. So right when he hit age 55, he was given an option of saying, "Hey, listen, we'll give you a set income on either your life or yours and your spouse's life." So him and my grandmother's life. So I always talk about the story. I said it was really kind of funny at the time, but I guess not so funny at the time. Was he was walking out the door and he already filled in his paperwork saying he's going to have a set income for his life only. And my grandmother stopped him and said, "What are you doing?" And he said, "Oh, I just filled out my retirement benefits." And so they get into a big argument because she obviously wanted to be set up on lifetime income as well. So that was known as a joint income option as opposed to a single life income option. So hypothetically, with the single life income option, the company, the employer, would say, okay, he was offered $50,000 per year for the rest of his life of income, as opposed to the joint income option, which maybe that was $40,000 per year. The single life only option, the $10,000 difference, means that right when my grandfather passes away, then the income's going to stop completely. The joint life income says him and his spouse, him and my grandmother, were both covered for $40,000 of income. If he was to pass away, then she would still be receiving $40,000 worth of income. So you have different types of benefits at that point in time. Right when you're getting ready to retire, you're going to have different options to say, we could either give you a period certain option, we'll provide you income for 20 years, we could provide it on your life only, on yours and your spouse's life. But if you're doing it, each option that you choose is going to have a certain level of risk. So obviously the risk associated with the single life only option, through the employer standpoint, they're going to give him the highest amount of income because it's only covering his single life, as opposed to when they're covering joint lives. Now that's a larger risk on their books to say, okay, now we have to basically cover two different lives of payments when it comes time for them to retire. Two different lives worth of payments, regardless of whenever the first person passes away, the payments will stop after the second person passes away. That little fight that they had worked out very beneficial for my grandmother because my grandfather ended up passing away at age 69. He retired in his 50s and he ended up passing away at age 69. Well, she ended up passing away in her late 80s. So the income would have stopped, she would have been, excuse my language, she would have been completely screwed if he would have chosen the single life only option. But therefore, because she stopped them, they chose the joint life. She was able to now collect income stream for the rest of her life until she passed away. So she was able to have Social Security income and then also the pension income, and therefore she didn't have to work at all during her retirement years because of my grandfather's pension plan or because the way that he set it up properly. So that's a pension plan. We understand with the pension plan, it's a defined benefit plan. And let me clear off the chicken scratch on the screen. And let's hone in on the 401k defined contribution plan. So individuals used to always get set up in a pension plan. They would work for a company, they would work X amount of years, and understand that they had a set retirement, a defined benefit when they retired. Well, in 1974, you had a branch of the government came out known as Erisa. And what it said was, rather than have all that risk associated to the employer, whether that be the city, the state, a private institution, whatever that is, that's going to define what the benefit was to all of their employees, we're going to now go and throw that risk onto the employee themselves. So we're taking the risk from the employer and placing it onto the employee. So after 1974, after ERISA was created, then you had the 1980s where you had certain plans such as a 401k became very popular. What this said was, we're just going to define a contribution, meaning that rather than define the benefit of how much you're going to receive for retirement, tough luck, start investing your own money. And you're going to now contribute, we're defining that you could now contribute into a type of deemed qualified retirement account. So what a 401k is essentially a retirement account that an individual could leverage. So if an individual is working for a specific company, let's say this individual is making $100,000 a year. They're saying, hey, listen, you could go and place a portion of your salary and place it into this type of retirement vehicle. This kind of think of it like a retirement bucket. So if an individual places 5% of their salary into this bucket, we understand that $5,000 is going into that bucket. Now, you had certain things that came out were more popular. It's something known as an employer match to incentivize somebody to stay at that company, and they would match you. So you might have like an employer match of 5%, saying if someone places 5% of their salary into the plan, then we're going to place 5% of our own money, of the employer's money, into the plan to match your contribution. So now you have $10,000 that are working for you that year. Well, unfortunately, in more recent times, with the economic shift, with kind of businesses going under and individuals not the unemployment rate, obviously being higher, companies are now saying, well, listen, we don't care about how much money we're actually giving you on the match. Be happy that you have a job. So therefore, we're going to give you a 1% match or a 2% match. So that's something that's more common in today's times. Now, there is a risk associated with this type of bucket. There's a risk associated essentially on both of these plans. What I've noticed is individuals that call my office that have pension plans and pension income are a lot happier because they have a set income stream that's coming to them for retirement, as opposed to somebody that was only contributing to a 401k plan or 401k and IRA plan. There's more of a question mark there because now they have to rely solely on strategy and there are no guarantees there. What do I mean by that? Well, with the 401k plan, we understand that this retirement bucket is going to grow by the amount of contributions that are into this plan from both the employee and the employer, but this plan is linked to something through some sort of interest credit. The way that that percentage credit works is it's tied to something known as mutual funds. Now, these are majority of 401k plans. They're tied to mutual funds. So a typical 401k account might be offered 5 to 15 different types of mutual funds that you could choose. So what this says is the mutual funds are essentially a risk that's associated there. Somebody could be placing contributions into their 401k account for 20, 30 years, and if this mutual fund performance drops, like in a really common example would be in 2008, mutual funds, took a big hit. The market took a big hit. So therefore, the average portfolio lost 57%. If we're just going easy math, and let's say the portfolio lost 50% of their 401k, in year 2008, then it didn't matter if this person had $1 million into this bucket as long as they kept contributing, because this interest credit came back negative, their entire retirement dropped down in half, and it got cut in half. So therefore, the person could be walking into the year with $1 million. At the end of the year, they're walking away with $500,000. So there's that lack of certainty. There's that question mark of saying, oh my gosh, what's going to happen with my retirement income? How can I properly choose a strategy to start pulling out money for retirement if that is that individual's goal? So a lot of times individuals keep contributing to their 401k accounts because they want to set aside money with the hopes that that money, that the interest credit that comes back is going to be positive. So even though the market has they're at the length of time, they're at the history of the stock market, the market has typically always gone up. What a lot of people don't incorporate is that downward market shift, and that's what could completely hinder and destroy retirement accounts and destroy your retirement planning livelihood or just your retirement life, when it comes time to start pulling money from that. A very easy example is you have a lot of wealth accumulation specialists out there, and they try to, always focus on the averages. And they said, oh, your account, average 2%, it average 3%. And what you have to look at is the actual rate of return. Because if you had an account that went down 50% one year and then went up 50% the next year, well, this would have averaged you 0% rate of return, right? If you use that $1 million example, and I just want to show you the impact of it. That's why I'm using $1 million example. Some people might be watching this video say, I don't have $1 million in my retirement account. That's outrageous. I want to show you the impact of how negatives could completely liquidate a retirement portfolio. If it went down 50% the first year, it would have been sitting at $500,000. Then if it would have went up 50% the next year, you would be sitting at $750,000. But on paper, it's showing you that your average rate of return was 0%, right? Your actual rate of return was minus 25%. So that's why if there's a way to set up your retirement and make sure that you're eliminating those negatives altogether and you're getting the power of compound interest, you're working with the market. Whenever the market goes up, you're capturing gains into your account. Anytime the market goes down, well, then you're receiving 0%, but you're not becoming hindered with that large downward market loss. Or even if you're using a simple example of, minus 10% in a given year, minus 10%. And then on top of it, you have 401k accounts that you have mutual fund related fees, possible advisor fees, 401k related fees. All those different things are now compounding in a negative aspect against your type of 401k account. So let me clear out the screen. And let's go over the bullet points that I mentioned over here, because this is going to really help clarify things on the differences between a pension plan and a 401k and how to maximize your specific goals in retirement. So with the pension plan, we understand that this is a set income. If you choose a single life only option, you have a set income for the rest of your life. If you choose a joint life option, you have a set income for the rest of your life, dependent upon the entity that is backing that, set income. If you have a private institution, or if you have the federal government, or if you have a state, or if you have a city, that's essentially the one that's guaranteeing you that, that pension income. With the 401k, it's more based upon strategy. So there's more of a question mark there. You see a lot of different theories out there. You used to have something known as the 4% rule, saying that a safe haven should be, as long as I'm pulling out 4% of my income, there's a 90% chance of not outliving my money. And a lot of that 4% rule has actually been disproved. So there's ways that you could take your 401k monies, right when it comes time, right when you're eligible, you could roll those over into specifically designed IRA contracts that work very similar to how a pension plan works. So you could use that through the form of annuity contracts. You could use that through the form of different lifetime income riders. There's a couple of different ways on how you could set that up properly so that you're not just going through strategy and uncertainty, but you're correlating it more towards a specific set dollar amount. If you have $500,000 that's sitting in your 401k account and you need to have in the next 2 years $30,000 of lifetime income come to you, well, you could use a portion of your 401k dollars, roll it over into a specifically designed IRA contract that has specific guarantees associated with it that will provide you lifetime income for either you or you and your spouse, kind of like how that pension plan works. One of these other things with the pension plan is there's ways on how you could maximize out that income. With that example I was showing you with my grandfather and my grandmother saying, okay, the single life only option was $50,000 per year, and the joint life only option was $40,000 per year. Well, if they would have set this up properly, they could have had a life insurance policy taken out on my grandfather, and let's say that this would have been a $5,000 life insurance policy, and it would provide him $300,000 or $500,000 of a death benefit. What happens with that is this would provide this $300,000 life insurance policy would then be able to get paid out to my grandmother whenever my grandfather was to pass away. So he would be able to net that additional $5,000 every single year, because $50,000 minus the $5,000 for the life insurance policy would have resulted in $45,000, which is $5,000 higher per year than the joint lifetime income option. Let's say they're living. He's living into his 60s, his 70s, his 80s. They would still be able to receive that additional $5,000 of income over the joint life option. God forbid something happens to him, then $300,000 would get paid out to their beneficiaries. Let's say would get paid over to my grandmother. Let's say that she passes away before him. Well, now he'd be able to net $10,000 per year. He could cancel that life insurance, be able to net $10,000 per year more of lifetime income. So that's just a little quick way on how you could set up that type of pension income and set up your pension plan properly. But there's a couple of different factors. First off, the person has to be eligible for life insurance, has to be able to, you have to make sure that the dollars make sense to try to set up that plan properly, and it's going to be as most efficient as possible. Over here we have lack of death benefit versus lack of certainty. So with the 401k plan, when you roll them over into specifically designed IRA contracts with lifetime income riders, you could understand that whatever you do not spend, let's say if an individual goes and uses, out of that $500,000 example, they use $300,000 to provide that $30,000 per year of lifetime income. As they're taking out $30,000 every single year, and let's say that person was to pass away, whatever's remaining into their account value, into their bucket, would now be left to their beneficiaries. With this portion, the downside to pension plans is there is usually not a death benefit associated there. If you're choosing a single life only option, that's the risk that the person is playing with. Something happens to him, then the income's going to stop altogether. If he only lived for 1 year, then the employer made out like a bandit because they only paid one income payment or 1 year's worth of income payments to that single life only recipient. Let's say the joint life income option. After the second spouse passes away, there's typically not a death benefit associated there. So there's certain ways on how you could cover that death benefit if you want to leave some sort of inheritance while still making sure that you're receiving that set income, in retirement. So in closing, understand with pension income, there's ways on how you could maximize out that income. You could set it up, you could utilize insurance products, you can make sure that there is a death benefit there to the surviving spouse, you can make sure that you're netting out, and you're leveraging the best possible strategy to make sure that you're getting the highest amount of lifetime income. With the 401k, you're at an advantage because even though during your working years you didn't think that you were able to have that defined benefit type plan, there are ways that you could roll over your 401k accounts into specifically designed IRA contracts that give you a maximized growth onto this account and then also provide you maximized income onto that account that will be income for the rest of your life or you and your spouse's life. So in closing, I want you to review this video. Let me clear up the screen. And if you found value in some of my talking points or you were interested in speaking with a specialist, simply give our 1-800 number a call. It's 1-800-566-1002. We have 24/7 customer service, meaning you can give us a call at nights, weekends, holidays, anything that basically would pertain best to your specific need when you do need to speak with us, and we'll be standing by. Essentially, you'd ask the assistant who answers the phone. You say, I want to speak to a defined contribution specialist, defined benefit specialist. I saw a video online, whatever the case may be, and they'll patch you over to a specialist. And that individual's going to ask you a slew of questions, try to gather up what your goals are, and then educate you first and foremost. We are A+ rated on the Better Business Bureau. We've never had any complaints. We've always had very good reviews. It's because of our methodical process. We understand that education has to be the forefront of any sort of financial plan especially when you're looking for retirement. The problem with retirement is you only have one chance to get things done correctly. You want to be confident in what your plan is. You want to fully understand it and not just say, oh, well, this advisor sounded smart, so I'll just give him all my money. That's the worst thing. That's where what we always see happens with these retirement disasters out there. So prevent the retirement disasters from happening to you. Give us a call. You'll deal with a specialist and be further informed. And I really hope you enjoyed this video. Please make sure to subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. Thanks so much, guys.